Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. In capital markets, how a company is perceived and how it performs are closely connected. While executives often focus on things like growing revenue, improving profit margins, or renewing strategies, investors judge success mainly by one key measure: total shareholder return, or TSR. This metric shows the real economic result for shareholders by combining both the rise in share price and the dividends paid over time. Although TSR is commonly mentioned, many organizations don't fully understand it. Leadership teams may celebrate when share prices go up or blame declines without really knowing the reasons behind those changes. That's where TSR decomposition comes in. It breaks down shareholder returns into their basic economic drivers, helping CFOs, boards, and executives analyze past results, separate lasting value from short-term effects, and create strategies that build shareholder wealth over time. Recently, with markets becoming more volatile and interest rates shifting, TSR decomposition has gained popularity as a strategic tool in boardrooms, especially among CFOs, investment committees, private equity firms, and activist investors. It offers a shared language that connects strategy, operations, finance, and what investors expect. Total shareholder return, or TSR, measures the complete return. An equity investor gets over a set period, combining changes in share price and any dividends paid and reinvested. It's calculated by taking the difference between the ending and beginning share price, adding dividends, and dividing by the beginning share price. TSR stands apart from accounting metrics because it captures market judgment, reflecting not only how a company performs internally, but also investor expectations, perceived risk, interest rates, and wider market conditions. This makes TSR a key link between what a company does inside and how the market values it externally. While TSR decomposition is mainly used for publicly traded companies, private equity investors apply a similar approach by looking at entry and exit valuations based on EV, EBITDA multiples, operating improvements, debt reductions, impact on equity, and cash distributions. For instance, they might analyze growth in EBITDA and margin expansion to understand value creation. This approach helps adapt the TSR framework to private companies, ensuring it remains useful across different ownership structures. What we're looking at here is a breakdown that resembles total shareholder return, or TSR, but it actually focuses on the drivers of equity, internal rate of return, not market TSR itself. The key differences are that public TSR relies on market prices and is continuous and market-driven, whereas private TSR-style measures are based on appraised transaction values, are point in time, and are deal-driven using models. This approach is especially relevant for family-owned or closely held companies. TSR decomposition can still be strategically useful if the company undergoes periodic valuations, pays dividends, or allows cash extraction and has a clear equity baseline. In this scenario, TSR acts as an owner value creation decomposition tool. However, it's important to remember that valuations here are subjective, multiples are assumed rather than revealed, and results depend heavily on the scenarios applied. This method helps promote discipline in capital allocation, supports tracking value across generations, and aids governance. Total shareholder return, or TSR, can be broken down into four main drivers: revenue growth, which is about growing the top line; margin change, which reflects how operating profitability improves or declines; capital allocation and efficiency, which includes how well the company uses capital; maintains balance sheet discipline and manages dividends and share buybacks; and valuation multiple change, which refers to how market valuations move, such as changes in the price to earnings ratio or enterprise value to EBITDA multiples. In simple terms, TSR equals operational performance plus capital discipline plus market re-rating. This way of looking at TSR helps leaders answer key questions like whether returns came from actual economic improvements or just market re-rating, whether those returns are likely to be repeated or are more cyclical, and which factors management can influence directly. The practical value of this framework lies in its ability to separate what the business actually did from what the market perceived, something especially important in volatile markets, where valuations can shift independently from fundamental performance. For example, a company might see strong TSR because of multiple expansion triggered by lower interest rates, not necessarily because the company performed better. Without this decomposition, leadership might wrongly attribute success and take risks unnecessarily. Additionally, by clarifying which levers actually drove value, this approach informs better strategic decisions on where to focus investments and how to design cost and efficiency programs. Deciding between organic and acquisitive growth helps ensure that strategy focuses on creating real value, not just activity. Many CFOs use TSR decomposition to align management incentives with long-term value drivers instead of short-term share price changes. This approach also improves communication with boards and investors by providing a clear, credible explanation of TSR performance, which builds trust. When performing TSR decomposition, start by defining a consistent time horizon, typically 3 to 5 years, to balance out short-term volatility, although shorter periods may be used for specific tactical insights. Next, calculate the total TSR over that period, including dividends. Then break the TSR into components, typically starting with the impact of revenue growth, which reflects how much TSR comes from increases in revenue volume and pricing, followed by margin impact. This structured process helps clarify the true sources of shareholder value. Next, we isolate the impact that changes in operating margin have on shareholder return, whether that improvement or decline. When looking at capital allocation, it's important to assess how share buybacks, dividends, and debt reduction or shifts in leverage contribute to overall value. Another key factor is multiple change, which refers to how valuation multiples expand or contract. This is often the largest influence on shareholder return, but also the hardest to control. Then, CFOs compare these results against peers by benchmarking against direct competitors, industry averages, and market indices. This comparison helps determine whether value creation is driven by company-specific actions or broader market trends. Finally, the critical step is using these insights to inform strategy. CFOs translate what they've learned into action by rebalancing how capital is allocated, redesigning incentives, and adjusting the company's approach to growth and risk. This ensures the decomposition is not just an analysis, but a tool for driving real informed decisions. Over a 5-year period, shareholders saw a total return of 70%, which breaks down to an annualized return of about 11.2%. This return includes the increase in share price from £100 to £150, along with dividends paid totaling £20. To understand how this return was generated, we start by looking at the financial fundamentals at the beginning of the period. At year zero, the company had revenues of £1,000 million and an EBITDA margin of 20%, resulting in an EBITDA of £200 million. The company's net debt was £400 million, and applying an EBITDA multiple of 8 gave us an enterprise value of £1,600 million. Subtracting net debt from enterprise value, the equity value was £1,200 million. This baseline helps us frame where the share price and shareholder returns originated before we move on to examine the drivers of change over the holding period. At the end of year 5, we see revenue has reached £300 million with an EBITDA margin of 23%, resulting in an EBITDA of £299 million. Net debt stands at £300 million, and the EBITDA multiple has increased to 8.5 times, leading to an enterprise value of £2,542 million. After accounting for net debt, equity value is £2,242 million, up from £1,200 million at the start, which explains the share price rising from £100 to £150. To break down the total shareholder return of 70%, we look at 3 main drivers: fundamental performance, cash return, and multiple change. First, if we hold the EBITDA multiple constant at 8 times with an ending EBITDA of £299 million, the enterprise value would be £2,392 million. Subtracting net debt of £300 million leaves an equity value of £2,092 million. This represents the fundamental value created without factoring in any multiple expansion, showing how much of the equity value increase comes purely from improved company performance. Starting with an initial equity of £1,200 million, the fundamentals contributed an increase of £892 million, which is a 74% rise relative to the starting equity. This rise in shareholder value comes from revenue growth, margin expansion, and improved capital efficiency. Next, looking at cash return to shareholders, total dividends paid were £20 per share, based on a starting price of £100, which adds another 20 percentage points to the total shareholder return. Finally, when we consider the expansion of the multiple from 8 to 8.5 times, the equity value increases from £2,092 million to £2,242 million, adding £150 million or 12.5% of the starting equity. These three steps together explain the main drivers of the total shareholder return over the period. Looking at the total shareholder return, we see that fundamental growth contributed 74%, cash returns through dividends added 20%, and multiple expansion contributed 12.5%, bringing the total to 106.5%. However, the actual share price only rose by 50%, from 100 to 150, with dividends at 20%, and the price already reflecting the impacts of multiples and timing. To fully match the observed 70% TSR, we convert these contributions into annual compounded figures. This breaks down to around 7.9% per year from fundamentals, 3.7% from dividends, and 2% from multiple expansion, totaling approximately 11.2% annually. It's important to note that while these parts explain the overall TSR, their sum isn't perfectly additive because TSR compounds over time, so only the total TSR is mathematically precise. In a real-world scenario, a technology company delivered 40% TSR over 3 years. The decomposition showed minimal revenue growth and flat margins, with most of that return driven by valuation multiple expansion, illustrating how strong multiples can mask weaker fundamentals. The CFO used these insights to advise the board against pursuing aggressive acquisitions, understanding that a reset in valuation could wipe out any gains, so the focus shifted to maintaining strong margins instead. In one example, an industrial manufacturer saw significant improvements in margins and return on invested capital, but total shareholder return lagged behind peers because gains were offset by multiple compression linked to sector re-rating. To address this, the company adjusted its investor communications and capital return strategies, which helped restore confidence and improve long-term returns. Another case involved a consumer goods company that achieved moderate revenue growth but delivered exceptional shareholder returns through disciplined buybacks, strong free cash flow conversion, and steady dividend growth. Analysis showed that capital discipline rather than growth was the main factor driving value. Overall, TSR decomposition offers clear benefits by breaking down complex performance into understandable economic drivers and promoting strategic discipline. The image here illustrates this concept, showing a hand guiding arrows and a rocket upward, symbolizing focused and disciplined growth strategies driving shareholder value. TSR decomposition helps leadership teams avoid pursuing growth that doesn't lead to actual returns. It brings management, the board, and investors onto the same page by aligning their views on company value. This approach works well no matter the sector, economic cycle, or geography. However, there are some limitations. It looks backward to explain past performance, so it needs to be paired with forward-looking strategy. Short time frames can be misleading because market valuations can swing temporarily. Also, it might oversimplify by not fully capturing intangible factors like brand strength, innovation, or company culture. There's a risk that if incentives rely solely on TSR without breaking it down, it could encourage short-term thinking. Today's CFOs incorporate TSR decomposition into key areas such as annual strategy reviews, decisions on capital allocation, designing executive compensation, and communicating with investors to ensure a well-rounded view of value creation. Total shareholder return is the key measure of how well a company is doing, but its value depends on truly understanding what drives it. Breaking TSR down into its core components helps CFOs and boards see what part of the return comes from real, lasting value creation versus temporary market changes. This approach acts as a bridge connecting finance, strategy, and what shareholders expect. In today's volatile, closely watched environment, TSR decomposition brings clear insight. It encourages honest discussions about value drivers, enforces discipline in how capital is allocated, and keeps strategy grounded in economic reality. When used effectively, it not only explains past performance, but also helps improve it going forward. For modern CFOs, using TSR decomposition is essential. It's how value-focused leadership is practiced. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.